Hey everyone, welcome to Long and Short. I'm Tom Hartman, Marketing Manager at TradersPost, joined by Mike Christensen, co-founder and CSO. In this series, we'll be walking Peter Hartman, another member of our marketing team, and my twin brother, through the process of setting up an automated trading strategy from scratch. This isn't a polished course, it's genuine, behind-the-scenes journey as we explore exactly what it takes to get someone with nothing, zero knowledge of trading experience up and running confidently. So let's dive in. All right, Peter. So last week, Mike, if you just remind us for last week, we went over indicators and strategies, like how to find them, right?
Yep, we looked through the community. We found some ways to differentiate between the indicators and strategies. We saw that there are also some metrics in there as well. It's kind of a new category of tools that are available on TradingView. But ultimately, we wanted to find the strategies because those are the things that actually generate our buy and sell signals. So I thought we would really kind of run through today on what a strategy really looks like in the TradingView environment, how the trading simulator works or the strategy tester works, and really kind of the gotchas and traps one can fall into when they're walking through the strategy optimization process or strategy selection process. Let's get into it. And of course, Peter, feel free to interrupt us, ask questions along the way. This is a very comprehensive process, and there's way more to this. Like, one of the caveats I can say about the TradingView environment is that it is a limited backtest environment, insofar that it doesn't go back very far, especially if you're on the lower time frames. Like right now, we're on the 2-hour chart. So it's pretty far back. I think the earliest trade probably goes back to 2018 here?
2020 even.
2020. Okay. So it's 5 years of data that it's trading here, which is pretty good. And there are definitely hundreds of trades in this strategy, but it should be known that in other types of backtest environments, you're able to go back to as far back as 2000 or 2002, or in some cases, people will stitch together tests that go back to the 1990s. And by traversing more of that history, you capture more of the patterns that are available in markets and confirm that your strategy is more robust. So without going too deep into the backtesting science, what I did want to cover are the highlights of how the simulator works here so that you can make a good selection on a strategy that you feel like can stand up, and then point out that the most important thing you can do once you've made a decision about a strategy to run is to run what's called a walk forward test. And that walk forward test is basically setting up the signals to go to TradersPost so that you can watch the incoming trades and then verify their performance on data that wasn't available in the backtest, right? Like, if you're familiar at all with the data science process, there's the concept of in-sample and out-of-sample data. Well, the walk forward test would basically be a way to say, I'm now going to test this strategy on data that the world has never seen, because we're testing it on live data that's coming in today and tomorrow and the next day and so on.
What's the difference between a walk forward and a paper trading?
It's still the same. Walk forward can be done in a live account, but I would always recommend doing it in a paper account, so that you can kind of, not put any real capital at risk, obviously. But the walk forward test is more about exposing your back test to data that it's never seen before. Whether that's in a live or a paper account is totally up to you.
So right now, when we're going to take a look at the results for the strategy, we can only measure it on the bars you see on the chart, right? And the bars you see on the chart right now are all the past. We're making an assumption that the same sort of conditions will exist in the future, but it's no guarantee. And so you can actually find out, like Mike was saying, all kinds of problems you have with your thinking by actually, after you finish designing a strategy, running it on right now, from now into the future, and then compare those results to your backtest results to see where you've gone wrong. Right. So I just wanted to pull up something over here. So last time we took a look at the idea for indicators. Remember that, Peter, where we go into indicators and we can find something here. I just find a VWAP trend. So this is a VWAP is a common indicator, volume weighted average price. Just think of that as the mean of the prices here, weighted by volume. And so here I just have an indicator that I created for myself just to get an idea of the trend. Green is bullish, yellow is consolidation, and red is bearish, as you might imagine. But then I wanted to be like, hey, I wonder if I could turn this into if I wanted to automate signals from this when it changed from green to red, I would have to go through the alert system like we did last time, click for this particular indicator, and then decide on what values count as buy and sell, and which we looked at last time. But let's say I've already gone through all that, or someone else already went through all that, and they created a strategy. That would be a different type of script that shows up with this
strategy icon.
exactly the strategy icon here.
I know we saw that last time.
That's right. And now that we add this to the chart, what I'll be able to see is the same indicator that I had before, because it's based on the same one. But now I'm seeing buy, sell positions on the chart. Right? It's actually plotting trades on the chart based on conditions that I set up within the code for this. Right? Don't worry, Peter. You don't have to code. We're not going to go through all the bunch of coding thing. But the idea here is that the reason we're doing this is that we can get to see the data that's being collected over here. Let me just disappear us. So here at the bottom of the screen, I can see some information that's giving me some view of what happened with all these trades. So for example, it's saying that 241 trades have been done, right? And it's letting me know that of those 241 trades, 40.25% of them were profitable, right? It's not telling me how much profitable it is. It's just saying that 40% of the time the trade ended at 0 or above. Profit factor, it's letting me know that, hey, on average, my wins, if I were going to consider my wins and my losses, I had a profit of 1.738 over here. Obviously, if you have this number that's at less than 1, it means you're losing money with the strategy. If you have it at more than 1, you're gaining money. And if you have it at 0, well, there's no point in running it. You're not making anything.
How can you be gaining money, profit factor of 1.738, when the percentage of profitable trades is less than 50%?
Yeah, that's a good question.
Great question. Yeah. So it means that of my winning trades, they're winning more than I'm gaining more money from that than the money I'm losing when I'm losing. So it might be, let's say, in this case, 1.7. It's saying that on average, when I win, I'm getting 1.7 times more than when I lose.
So you could have a strategy that only wins 10% of the time, but when I win that 1 out of 10 times, I make 20 times more than I lose. So I have a bunch of really small risks, for example, but I have one really big trade that wins a whole lot more. So when you're thinking about the expectancy or the outcome of your trading strategy, it's not just the win rate. It's the win rate and the profit factor that matter most together, because you can still have a high or a winning strategy that still yields positive results even with a low win rate. In fact, it's very common to see, as we've discussed here before, there's really kind of two types of trading strategies out there: trend following strategies and mean reversion strategies. It's really common to see a really high win rate with mean reversion strategies, but their risk to reward ratio is slightly tighter. And it's common to see a little bit lower of a win rate for trend following strategies, but their risk to reward ratio is a lot better. Like I tend to look for strategies, especially in trend following, that are between 60 to 70% win rate and have roughly a 1.5 to 2 profit factor. And so it's the two together that matter.
Peter, do you remember what the difference is between a trend following and a mean reversion strategy? Pop quiz.
Oh, yeah, I think I could remember this, but
So for trend following, what you're doing is that you're trying to, let's say over here, this is a trend. This is where the price moved in a particular direction for a while. And so for a trend following, they're trying to capture as much of this move as they can, right? So they might wait for a trend to be established, like over here, get into the trade, and then get out, let's say at a certain amount, leaving the rest. Whereas a mean reversion, someone might say, hey, if I take a look at this price, it's going up and then down and then up and then down. And so when it extends a lot in one direction, I'm going to put a trade to profit when it goes down, and then I'm going to profit the other way when it goes back up, because I'm trying to aim towards this mean, let's say. So that's what I want to be following. And most strategies especially that retail traders are going to be dealing with, fall into these two categories.
A trend strategy, is that riskier?
It depends how you. It depends on the trend. Depends on the asset. Depends how volatile it is.
Yeah.
So, for example, the SPY. If we take a look at the SPY, if I were to say, "Hey, I'm doing a trend on this, and my time horizon is 10 years," well, chances are I'm going to go up and to the right. And if I was betting on these things happening, these mean reversions happening, that might come. It might be once a decade, once every 5 years that it might happen, and so you'd have to size it differently. But if I'm on the 5-minute chart and I'm trying to get these changes, that might be a little bit easier. It may be a little bit easier for mean reversion depending on what you're doing.
Got it.
So if we take a look at the strategy, let's go back to here.
Back to the 2-hour chart.
Yeah.
So maybe one thing to cover right off the bat here is it's important to recognize that the strategy tester is just a simulation, which means that if you make any change to your strategy settings or indicator settings on the chart, that's going to change the performance of the historical backtest. So if you were to change like even just the start date or the leverage multiple or any type of setting in here, and of course every strategy that's made on TradingView has all kinds of different settings that are baked into it that can lead to dramatically different results in the simulator. So as we're looking at the history of how this would have performed in the past, what we're really doing is testing our current strategy settings against the past and seeing how it would have performed. That also means that the even small changes can lead to dramatically different outcomes. One of the things that is often overlooked when it comes to looking at the performance of a strategy, let's say you've dialed in your settings and you're really happy with that performance, is the cost of trading as well as changes in market price, and we call those commissions and slippage. So if you go to the properties tab of the strategy, you'll see here that very often the author won't even put a commission or slippage model in place in the strategy tester. And the moment that you actually account for commission, which often occurs, especially in crypto, you're always paying some small amount of a fee to the exchanges in order to participate, but then also incorporating some amount of slippage into the model as well to be realistic about whether you'll get into the position at the price you expect. That change in slippage can make it to where the whole strategy is not even profitable anymore. And this is something that's discovered usually when you go through the walk forward test. You feel good about the performance in the strategy tester, but maybe you forgot commissions and slippage. Then you run the walk forward test and you see that once it hits the exchange and they've accounted for slippage and commissions, suddenly it's not a profitable strategy anymore. And of course, we have many customers on TradersPost that go right to a live account, get it running, and realize after 50 or 60 trades that it isn't actually a performing strategy because of those two things.
So that's a very important point here, Peter, because what happens is that you have people who are strategy builders and people who even sell strategies, and chances are that the strategy seller doesn't want to account for slippage or commissions or anything like that, because it's harder to make a strategy work that way. They want this line to be green up and to the right with great numbers over here.
So they
And
on purpose don't include that?
well, you can understand why they might not, right? So they're not promising that you're going to get a particular type of performance. In fact, if anyone promises you that, be very careful. They're not promising you that. They're just saying, hey, my setup is giving me buy and sell signals that I think are worthwhile. Run it at your own risk. And here's the kicker: sometimes, depending on the asset, depending on the time frame, depending on the time of year, it does work. Even with commissions and slippage, it works great, but it doesn't work under other circumstances. Or there's a problem within it where it might accidentally leave you open in such a way that it blows out your account, like you get a big loss where you didn't expect, or you might get a big win. So that variability exists there. So they don't promise anything. But what's important is if you're developing your own strategy, you almost want to be, if your strategy doesn't work because of the commission and slippage, then your strategy doesn't work. right? So you want to sort of like develop with that in mind, because people really will fool themselves with what they want this to be green and up and to the right. They really fool themselves. I've had people who I tell them, hey, you're going to have to add in your commission and slippage and all that. You're going to have to add that in because you're going to get poor results. And they go, no, I'm going to work off of this first. I'm going to refine my buy and sell signals, and then when I run it, then I'll take care of that. And I go, oh my god, you've just not accounted for how the market actually works, because oftentimes Mike, you probably see this too. People will have it, and they'll see the number of trades. It'll be like over a period of a month, and there'll be like 3,000 trades,
Right.
and they'll be like, oh, it's great, it's working. 3,000
Except
trades is
the cost of
fantastic.
taking 3,000 trades is a lot. Yeah.
Just the cost of it
Mhm.
would eat up a bunch of their
Right.
profits, much
Yeah.
less the slippages and all that. So,
So
can be
maybe
useful.
another thing to consider here to add to this domain, what Tom was saying earlier, if commissions and slippage cause your strategy to no longer work, then your strategy no longer works. That can be really discouraging for people because they feel like they invested all of this time into developing their approach and coming up with their signals and writing the code for everything. And then they feel really dejected that these realities of how markets work cause their strategy to no longer work. So we kind of have this like baked in incentive cause bias to try to ignore some of these factors, and then we put live capital in front of it, only to find out that it truly isn't going to work, and then we're just kind of bummed, and we abandon the process. Well, we don't want any of that. We don't want people to feel that way either. So instead, we kind of have to begin this process with an opposite philosophy in mind, which is the idea that we should start with the belief that this strategy is likely not going to work. In the backtesting realm of the theory behind all of this, this is called rejecting the null hypothesis. Basically, we're saying we don't think this is going to work, and we're attempting to reject the null hypothesis. Basically, meaning we're proving we're trying to reject the idea that it doesn't work. I know it sounds like a double negative, but the idea is to go into this believing there's likely nothing here, but let me continue to keep testing it in ways to prove that it doesn't work, unless I have to reject the null hypothesis, meaning that it does actually work. In the case that it does actually work, it means that I've gone through all the steps to verify things like, did I account for commissions and slippage? And did I account for another really tricky thing, which is called overfitting? I don't know if you can kind of like illustrate this on the chart here, Tom.
Absolutely.
But overfitting is probably like one of the most common things that people run into. It's basically writing the strategy in a way that perfectly accounts for the history of the chart that you're looking at and getting the best outcome as a result. It's another reason that over optimization is a really bad idea, because all you're really doing is just continuing to play with different moving averages, different numbers, different settings until you get the number that you're hoping for.
That's right.
That's overfitting. That's basically just mapping the model, the strategy to fit the past, and that doesn't mean that it's going to work in the future.
So this is a classic example. Let me see if I could show you this over here. So over here, you can see on my chart, let's say percent profitability, profit factor, net profit, just to get that idea. So here I'm using a trailing profit of 4. Let's say I increase that. So this is what some people will do. They'll increase the number. They'll say, okay, 4 to 4.5. They'll look at the number, and they'll be like, okay, this number now is 38. Okay, so let me try 7 or 6 here, and they'll just keep adjusting the numbers until it gets to the highest number that they can see, thinking that this means that my strategy is running well. Maybe I shouldn't have chosen my strategy, because my strategy is well made. I should have pulled up one that's like terrible. But you have these things where actually, let me change the multiple here. That might
This is very similar to the problem that AI is facing, because they train their models to pass benchmarks, but then the AI can't reason outside of their training, outside of the examples that they were given.
well, it's like to me, I think of it as I'm driving a car, and then I went really quickly through a stale yellow light or even a red light, and then I didn't have an accident. So I'm like, okay, if I just go 30 above my CB, I'm fine. And then you're like, no, but at some point this will fail. So, but it didn't fail the last
Yeah,
30
that's
times I
right.
did it. No, you don't understand it. The fundamental nature of what you're doing is flawed. You will eventually have a big accident. And so I think of it. I see people do overfitting when they're like, hey, if I just actually gave the stop loss just a little bit more room,
Mm.
if I made the stop loss just a few more percentage, then it would have been great. No, it would have been great the last 6 months.
Right.
I got a question. Sorry.
Yeah, go ahead.
Is commission and slippage different depending on what country you're in or time of day?
Not
Time
well.
of day, certainly.
Time of day, certainly, because it has to do with market reflexivity, meaning the volatility in the market. How many participants are available at that time? How fast is price moving? If price is moving really fast right now because of high volatility, and I'm trying to get in at $100, by the time my order hits the exchange, it might already be at $105, and I didn't actually get the price I was hoping for.
Like
Right.
over here in this big drop, you can imagine someone trying to get in, and the price has moved drastically away from when they initially created the order. Whereas over here, it chopped in this range for a while. So, I mean, they probably almost definitely got the price that they were looking for.
Mhm.
Can you
But for
buy a range, like instead of setting a price to buy in, to set a range to buy in, like between 100 and 110?
yes,
That's a better way to look at it. Maybe the way you're describing that would fall in line with what I would refer to as getting the meat of the move. I don't want to write a strategy that requires I have to get in at exactly $100. I want to write a strategy that can get in at $100 to $105 and then take profit somewhere around 115 to 120 and still make money in between. That allows me to account for slippage in a way that still makes it profitable. The other question that you asked about, place in the world or time of the day, the other factor to consider with slippage really has to do with the market that you're trading, or the instrument that you're trading. If you're trading like a really small penny stock, for example, that there's not a lot of market participants around, price might be appearing to move really fast because there's so few market participants that it will jump from one price to another really quickly, and that's not really a good sign that it's volatility. It's actually a problem of there just not being a lot of depth in the order books. There's not a lot of market participants to get you in at a price that will make sense.
that's right. So if I don't know if I'll show it here, but on some in cryptocurrencies, for example, on the Bitcoin is a highly liquid cryptocurrency, whereas the day Pepe the coin launched, there might not have been a lot of liquidity there, or some podunk coin that you put out today that has 10 people trading it is not going to have a bunch of orders on there. So when Mike is talking about the depth of the order book, he's saying that the broker is always matching buyers and sellers, buyers and sellers, and buyers and sellers. They're always matching these orders together. And if there's a lot of orders that are happening, then it could probably get the match that you're looking for. But if there isn't, well, then you might even have to wait. I've even had order sometimes on some obscure futures where I have to leave that order on the book for a while before that option gets purchased or what have you, because not a lot of people are trading that strike on that option and that price for that period of time.
Gotcha.
So maybe to continue to look at the overview tab here, one other thing that we can kind of take a look at here is to compare the performance against buy and hold.
That's right.
This is a pretty important factor. Tom, if we can take us off the screen so that we can see this a little bit more clearly. In the top here, of course, TradingView has broken this down to say, here's what the net profit would have been if you started with the starting dollar amount in your account, and here's where you would have ended up at over the entire backtesting period. You would have traded 282 trades, 23% of them were profitable. Profit factor was 1.61. You had a max drawdown of 31%, meaning that somewhere in the middle there was a drawdown in your equity to roughly 30% of the account, but you still ended up net profitable, right? Your average trade made you about $12.63 a trade, and you were in those trades for 14 two-hour periods, according to this chart. But the blue line here is the important thing to consider. If you had just bought and held this position over that, 5-year period? Did we discover this goes back to 2020?
Yeah, that's right.
If you had just bought and held, you would have made a whole lot more money than trading in and out of this position 282 times over this period of time.
which is
So
brutal.
yeah, it's brutal. I mean, there's a couple of trade-offs you have to consider, though. The drawdown for that performance in that 5-year period was likely larger. It looks like, if I had to guess, that looks like about a 60% drawdown on that blue line. So it means that, yes, while you would have made net more in that position over that period of time, you actually took less risk with this trading strategy because the drawdown was a little bit better. You're not experiencing as big of a reduction in your account balance. If you had bought and held during that period of time, and let's say you have a $100,000 account, right? And you watched your account go down 60% and you've got $40,000 left in the account, there's a really strong chance that you might have pulled the plug on that. So you have to decide on this trade-off between the buy and hold approach and the risk managed approach of potentially getting less of a net return, but not experiencing as much pain in the process.
Interesting. So, but that only works if you put 100,000 in right at the start. If you bet it all at the beginning of the 5 years.
Sure. Yeah. All this simulation is based on an imaginary amount of money. This could be $1,000 that you originally started with, but the analysis you're doing here is, what would happen if I had started 5 years ago with $1,000, and would it have been better for me to just buy and hold this position, or use this trading strategy to get better returns and manage risk better?
Also, I'll end on this here for the max drawdown. Some of these factors matter, not because. So, for example, for prop firms, something that I think we're going to get you to trade eventually. Prop firms, you're trading essentially someone else's money, right? And so you don't have the benefit on a prop firm account to be like, I could have bought and held this. The profit that you're making off of that, which is their appeal, you're trading someone else's money, you're getting the percentage of the profit. And so you might not necessarily need a strategy that's beating buy and hold, because that was never an option for you with a prop firm account.
Right.
You were doing that to accumulate profit that you wouldn't have had otherwise.
The prop firm needs you to take specific types of risks, and a buy and hold approach is too big of a risk for them. They want you in and out of the market quickly.
You might also decide that when we take a look at this blue curve down here, you'll see that Mike was talking about this too. The volatility of the blue line, the buy and hold line, for Bitcoin is high. It's a high degree of volatility,
crazy.
where you have less volatility in a sense, or you can have less volatility within a strategy that's evenly accumulating a certain amount. So if if you'd rather have a strategy that has less volatility, even though you're giving up some gains, you might want that, because what matters for some people, especially for longer term investing, is what will be the value of my account at the time that I need to withdraw the money. So I have the money in right now, and I'm planning on, I had this for my retirement. Well, I don't want it to be when I'm in my retirement, I'm at global financial crisis lows of 2008. Because I got, I don't want to be, I can't afford that. I'd rather have a strategy that's not giving me that level of return for the buy and hold that I might have had theoretically. I'd rather have this steady accumulation of funds. So I like, so for me, because I trade crypto, and you're going to be in crypto too, I do buy and hold, but because, like Mike said, I can't stomach the 60% drawdown or whatever that happens, I need to know that I have something else that's inching, that's constantly making money, even as I'm going through a bear market with holding an asset, which is a great reason to automate a strategy. It's just running, it's accumulating, and you're not worried about it beating the general market.
Yeah, it's been specifically designed to minimize the drawdown as well. There's lots of strategies that will do that too, that bake in like the maximum allowed loss in a single day, or it's no longer allowed to trade if there's 2 losses in a row. Like, there are many strategies out there that have those types of risk management rules built in to sort of circumvent this problem of drawdown that occurs in a buy and hold approach.
I have 2 questions regarding this. Is this why, Mike, you talk about buying a basket of things?
Well, the basket has more to do with diversification. So in this in this idea here, we might be talking about, I have, let's say, 10 different strategies, all with different ways to express a trade in the market, trading different instruments, but I don't want to put all my risk into one algorithmic strategy. Instead, I would rather trade all 10 of them at the same time, because it will smooth out my equity curve as a result. If you had watched our previous episode of Office Hours, this was actually brought up recently in our interview with Kevin Davey on Trading Bot Sessions, and it's something that he realized that was a big game changer for him early in his career, was diversification of his algorithms across multiple markets. So he might have a soy strategy for soybeans. He might have one for corn. He has another one for gold. He's got another for S&P 500 futures. But he's trading all of these markets at the same time. And I think if I recall that interview correctly, Kevin told me he had something like 40 or 50 different strategies running at the same time right now.
Wow.
And so that diversification just basically allows you to reduce the independent risk that can occur from just trading one instrument that has its own set of risks associated with it. So like, while the S&P 500 is going down, gold might be going up, or soybeans might be going up, or wheat might be going up, and vice versa. While those instruments are going down, the S&P 500 might be going up. So distributing or diversifying your risk out to multiple markets obviously helps smooth things out. So that's one form of diversification. The other form would be, let's say you only want to trade stocks. You're not interested in futures. You don't want to trade wheat or commodities or anything like that. I just want to trade stocks. Well, it's the same concept here. I just don't want to expose myself to the risk of one stock by itself. I want to trade that stock using my trend following strategy along with 9 or 10 or 12 different other stocks at the same time.
Awesome. And can you use one strategy for all of those things, or do you have to have multiple strategies for different stocks and different things?
There are many strategies out there that will work for many different instruments. I think we've seen this a lot in the TradersPost ecosystem, where a strategy developer will come along and say, we've tested this on 7 of the top major S&P components, maybe the Mag 7, for example. So it'll work with Tesla, it'll work with Apple, it'll work with, Microsoft and Google, and so on and so forth. And it's basically the same approach, because the trading strategy is simple enough to work with all of those markets at the same, or excuse me, all of those stocks at the same time. That's probably another really good rule to cover here in terms of strategy development. Simple is usually what wins. And Kevin talked about that in the interview I did with him as well. Simplicity matters. You're not looking for a trading strategy that's got a list of 700 different rules to go through, because that just increases the likelihood that you've overfit once again.
Right.
We're looking for very simple strategies that look for a really strong signal. And when that signal occurs, it takes that bet and it just holds that position until the signal's not there anymore. So the rules should be very, very simple. Things as simple as you saw a spike in volume and the close today is greater than the close from yesterday. That's it. Those are the rules there. Did I get enough volume that went above the moving average? And is the close closing higher? And then the flip side of that could be the inverse. I see a volume spike and the close is less than the previous close. That's it. Rules like that are sometimes some of the best strategies out there. The one I coded for the prop firm structure, it's an extremely simple VWAP strategy that I think had 3 rules baked into it. Stuff like that, I think, is what you're looking for. You're just looking to measure the general movement of the market, make a simple strategy, test out the results, make sure that you're getting the meat of the move like we talked about. You're accounting for things like some commissions and slippage. You're adjusting for risk by positioning your size down so that you're not taking huge risks on a single strategy, and then diversifying that. So I might have 5 or 6 different ways I'm thinking about trading in the markets, and I can be trading those different ways all at the same time on TradersPost.
All right. Well, that was fun. Peter,
That was my favorite one so
your
far.
little brain has got a little bit more information. You can bend that around there a bit. All right, so we're going to be back. The next episode is going to be we're going to dive more into the strategy performance tab, but also show how we're going to be connecting it to TradersPost, because we want to really get the automation part in here. And I think you'll like it. Well, actually, I think I'm going to get you to run some real money on this one.
Am I finally going to do it?
Exactly.
All right.
I think the next episode will be
Spend
the
some
good
money.
one. We'll see. All right, folks. Thank you so much for watching Long and Short. We'll be back next week.